Welcome back guys to another Zero DTE video, and today Ernie's going to be talking about the differences between options, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy guys.
I took a trade this morning. I actually took two trades, one for my reference account, which is the account that you guys see, and the other one for my other account. But I took them both in this tiny little account that I have, and I'll just deal with the money transfer later. And this is the account. The profit was up to about $400 for this NDX trade I made, but I made two trades. I made an ES trade and an NDX trade. The NDX trade is actually 50 wide. You might be wondering, 50 wide? Why'd you go 50 wide? Because a 50 wide relative to an SPX trade is actually like a 15 wide, because it's about 3 times the size. So that's why. And on the ES, I did a 15 wide. From a relative point of view, they were both about the same size, except that the costs are dramatically different. And that's one of the reasons why you might want to trade the NDX or the ES or the SPX, because of the relative size based on your account. So you have all these different choices that you could go with, where if you have a much larger account and instead of putting on, say, 5 ES trades or 2 SPX trades, you could put on 1 NDX trade. Make sense, right? The other reason why you might want to put on an NDX trade over an SPX trade is because there's naturally more volatility in the NDX. It tends to move a lot more. Besides the fact that it's bigger, it moves more on a percentage basis. That might make it another option for you to use in these markets. Now, of course, there's also the NQ, which is the futures version of the NDX, which has the same kind of volatility, but it is way smaller than the NDX. In fact, it's even smaller than the ES. It's less than half the size of the ES. So it's even smaller, but you get that same volatility. You might want to consider the NQ, and it trades also 5 days a week. Now, I don't know about the liquidity of the NQ. Got to take that with what it is and see whether or not that works out for you. But I don't know. Let's take a look. Okay, so here's my NDX trade, and you can see that it's got some profit in it right now. It has the potential of making almost $4,600. Actually, $4,550, I believe, is the max profit potential. Price could move a little higher up, and this could be a substantial trade. Let me show you my E-mini trade.
What did the NDX cost?
$4.50, or $450. Now here's my E-mini trade. All right, so this one here has about $50 of profit. So both full trades. Let's see what an NQ might look like to make sure that this date is tomorrow's date, and then that this date down here is today's date. That's not today's date. That's today's date. The open interest and volume doesn't look too bad here on the NQ. I mean, it's not great, but it's not bad. It looks like you could certainly open up. Why is the NQ smaller than the NDX or the SPX or even the ES? Does anybody know? Do you understand why it is smaller, even though the index is huge? Really has nothing to do with the size of the index, because this is a futures contract.
Is it because it represents 100 stocks, or?
No, there are no
versus-
stocks. It's a futures contract that it represents.
Well, I meant like the underlying concept of the index being the index 100 or NASDAQ 100.
The NASDAQ is just an index. It doesn't represent any stocks or anything, but indexes by default have a multiplier, or what's called a big point value, of 100. Now, it just so happens that stocks also universally, including ETFs, all have a multiplier of 100. Now, the fact that stocks, like you said, represents 100 shares underneath, there are no shares with the index. So it's kind of a moot point. So it's not representing anything. That's just a coincidence, or maybe a purposeful coincidence, that it also represents 100 like a stock does. But the reason why a stock does is because there are 100 shares that are represented by that contract. Under an NDX or an SPX, there is no underlying. So it's all cash delivered or cash settled. So they just made it up. So they just decided, hey, for convenience sake, let's make it 100. Now, futures, on the other hand, they all have something called a big point value that represents the contract size and the delivery size of the underlying. Now, in a NQ and the ES, the delivery is a ES or an NQ contract. In commodities, the delivery is the underlying commodity. And so then the big point value is a representation of the size of that delivered commodity. So in other words, with silver, this is crazy, the big point value is 5,000. Why is it 5,000? Because the delivery of a silver's contract is 5,000 ounces of silver. In gold, it happens to be 100. The reason why is that the delivery of a gold contract or a GC contract is 100 ounces of gold. In oil or CL, crude oil, the big point value of that is 1,000. That's because the delivery of a CL contract is 1,000 barrels of oil. You getting the picture? So that's where the different big point values come from futures. They are a completely different animal from stocks and indexes. They're their own thing, but the delivery is determined by the underlying contract and its delivery.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks, guys.